Welcome to the Money Tree Investing Podcast. Stock market, wealth, personal finance, value stocks. Invest in your life.
Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, we're talking with Richard Duncan, famous macroeconomist. I think you're really going to enjoy this week's show. I've been trying to get Richard on for months, and I appreciate him blocking out some time for us because this, for me, is a treat. How's it going today, Richard?
Great, Kirk. Thank you very much for having me on.
Richard, I know a lot of our listeners probably know who you are, but there's probably a few that don't. So maybe you could tell us a little bit about your background.
I am an American. I went to Vanderbilt, and after Vanderbilt, I ended up backpacking around the world for a year. And that really changed my life going forward. I saw Asia in early 1984, and already then it was booming economically. So I realized, go east, young man. And I went back and went to business school at Babson for a couple of years. And when I finished there, I flew to Hong Kong and found a job as a securities analyst. Since then, I have lived in Asia most of the time, with a few exceptions. I've only spent 2 years back in the US when I was in DC working for the World Bank for a couple of years. But other than that, I've spent most of my career in Asia. At one point, I was the head of global investment strategy for ABN AMRO Asset Management based in London, looking at all asset classes globally. And along the way, I've written 3 books. The first was The Dollar Crisis: Causes, Consequences, and Cures. Now I have a video newsletter called Macro Watch, and I'm working on a new book.
I'd love to talk about some of this. So you have a background. You've worked at the World Bank. You've worked for the IMF at one point during the Asia crisis. You have kind of a seasoned resume here from an economics perspective. Now, when I say economics, it probably puts a lot of people to sleep. But when you kind of look at the importance of macroeconomics, what would you say is the biggest thing that had an impact in the last few decades and the world stage?
There can be no doubt about it. The main thing that's happened on the world stage from a macroeconomic policy perspective has been the aggressive use of quantitative easing again and again to prevent the world collapsing into what would have been 2 new Great Depressions, one in 2008 and one last year.
When you say quantitative easing, I know most people know what that is, but maybe you could describe it, because I think when people talk about these terms, they get convoluted in the media. So from your perspective, what is quantitative easing?
So quantitative easing was really introduced on a very large scale by Fed Chairman Ben Bernanke. And when the crisis of 2008 struck, stock prices were collapsing, the economy was in free fall, and the Fed jumped in by they had 3 rounds of quantitative easing. What that means is that the Fed created money, as only central banks can do, and it used this newly created money to buy government bonds on a very large scale. So between 2008 and 2014, when the 3rd round of quantitative easing ended, the Fed created $3.5 trillion, which increased the amount of money they had created in total by somewhere between 4 and 5 times. So this was extraordinarily aggressive money creation by the US central bank. And by buying those government bonds, it pushed up bond prices, and therefore it pushed down interest rates. And the lower interest rates helped the economy revive. But also this process allowed the US government to finance its very large budget deficits, because between the end of 2007 and the end of 2014, US government debt doubled from roughly $9 trillion to $18 trillion. And it wouldn't have been possible for the government to borrow and spend so much money during that period. And of course, all of that government spending stimulated the economy and helped reflate the economy from its collapse in 2008. It wouldn't have been possible for the government to do that without pushing up interest rates. If the government had borrowed so much money in the absence of the support from the Fed through quantitative easing, all of that government borrowing would have pushed up interest rates and crowded out the private sector by making interest rates much more expensive. That the higher interest rates would have offset a lot of the good that came about from the additional fiscal stimulus. So finally, the money creation by the Fed, by pushing down interest rates, it also pushed up asset prices and drove up the stock market. So there were 3 rounds of quantitative easing. Every time the Fed launched a new round of quantitative easing, the stock market went higher. And then when that round stopped, stock prices started to fall. So they launched a new round and stock prices went higher. The second round stopped, stocks started to fall. They launched the third round and stocks went very much higher. So as a result of this, the wealth of the United States, the net worth of the American public, all of their assets minus all of their debts skyrocketed. And this created a wealth effect that also helped drive the economy and pull it out of the crisis of 2008.
Here's where it gets confusing, I think, for a lot of people. So effectively, the Federal Reserve purchased treasuries. How does that cause money to flow into the economy?
The real process is it's a cooperation between the Fed and the government, the Treasury Department. The money gets into the economy because the government borrows the money. In 2009, the U.S. budget deficit blew out to $1.4 trillion. It remained above $1 trillion for 4 years in a row. So you had the government borrowing a lot of money and spending a lot of money. And it was that spending of the money that gets the money into the economy. But it's the Fed buying the government bonds that gives the government the money that it spends. So that's how it gets into the economy.
You know, one thing that I've heard a lot in the last, well, if you kind of disconnect prior to COVID, let's just say, from 2008 till COVID, there were a lot of calls for we're going to have high inflation or hyperinflation for all the money printing that was going on, but that didn't actually happen. Can you talk a little bit about that? Because I think it's really important that people understand, the dynamics here.
Okay, right. So our economy doesn't work the way it did in the past. The big change came a little more than 50 years ago now, when dollars ceased to be backed by gold. Up until 1968, the Fed had to hold gold, or actually gold certificates, for all the money that it created. But in 1968, Congress changed the law and they removed that requirement. And 3 years later, Nixon destroyed the Bretton Woods system by reneging on the United States' promise to allow other countries to convert their dollars into US gold. So from that point on, there was no longer any link between dollars and gold. And this radically changed the way our economic system works. Let me explain. First, of course, when dollars had to be backed by gold, that limited how much money the central banks of the world, not only the Fed, but all the central banks, it limited how much money they could create or how much credit they could create. So that was one important change. Another very important change that will bring us to answering your question was that when money was backed by gold, trade between countries had to balance. Let me explain. Let's say in the 19th century, if England had a very big trade deficit with France, then England's gold would literally have been put on a ship and sent over to France to pay for the deficit. So England's gold would have contracted. In other words, England's money supply would have contracted very sharply. And as a result of the contracting money supply, England would have gone into a severe recession and unemployment would have gone up and they would have had deflation, falling prices. But the opposite would have happened in France. France would have had much more gold, so that would have allowed credit to expand. The economy would have boomed. They would have had full employment and they would have had inflation. So pretty soon, the rich French would start buying more cheap English goods, and the poor unemployed English would stop buying so many expensive French goods, and trade would come back into balance. There was an automatic adjustment mechanism under the gold standard that carried on into the Bretton Woods system that made sure that trade between countries balanced. So the United States didn't have big trade deficits. In fact, Bretton Woods broke down in 1971. So up until that point, say if the US government did what it did in 2008, or more recently after the COVID pandemic began, the government ran very large budget deficits. And if the central bank created enormous amounts of new paper money to finance those budget deficits, that would have quickly overheated the US economy. It would have led to full employment in the United States, and all of the factories would have been working at full industrial capacity. The car factories would be producing as many cars as they possibly could. So would the steel plants and all the other industries. And we would run into domestic bottlenecks coming from all of this government stimulus. And the domestic bottlenecks would have then resulted in higher prices. The workers would have demanded higher wages. The factories would have been short of goods. And so that would have caused higher prices for manufactured goods. And this would have resulted in a wage push inflation spiral, such as we saw in the late 1960s and early 1970s, because we then had a more or less closed domestic economy where trade balanced. The big change came in the early 1980s. Bretton Woods broke down in 71. It took the US just a few years to figure this out, but by the early 1980s, they discovered that the United States didn't have to pay for its foreign goods with gold anymore. It could pay with paper dollars, which it could create limitless amounts of, or it could pay with treasury bonds denominated in paper dollars. And there was no limit as to how many of those they could create either. So the US started running very large trade deficits for the first time in the first half of the 1980s. And by 1985, the US trade deficit had blown out to 3.5% of GDP. This was entirely unprecedented. It greatly concerned all the financial policymakers around the world. So the G7 met at the Plaza Accord and they in the mid-80s, and they agreed to devalue the dollar by 50% against the yen and the mark to bring the US trade back into balance. And that worked. The US trade came back into balance by 1990. But then soon after that, China entered the global economy. And because Chinese workers earn so little money, the United States started running very, very large trade deficits with China and many other low-wage countries around the world. So by 2006, the US trade deficit was 6% of GDP. That was $800 billion that year. Now, of course, that was fantastic for the rest of the world. That enabled the rest of the world to produce $800 billion worth of goods more that year than they otherwise would have been able to do. And this went on. That wasn't just a one-year occurrence. This went on for decades. And as the US trade deficit became larger and larger, this allowed countries like, well, first Japan, but later Korea, Taiwan, Indonesia, Thailand, where I've spent many years, Malaysia, then China, Vietnam, increasingly India and Bangladesh. They've all been able to grow by following a strategy of export-led growth, exporting for decades to the United States. For the US, what this meant was that we no longer had to rely on the domestic labor force or our domestic industrial capacity. The global population is, I think, 23 times larger than the US population. So suddenly, when the US started running large trade deficits with the rest of the world, it didn't have to worry about running up against domestic bottlenecks in labor and industrial capacity anymore, because we could buy from the whole world. And the whole world, most of the world, their workers earn wages that are as much as 95% less than US wages. And so by buying from the rest of the world, this was extremely deflationary. It drove down the price of industrial goods in the United States, and it pushed down US wages as well. And so what this meant in practice is that the US government found after 2008 that it could run trillion-dollar budget deficits year after year. And moreover, it discovered that the Fed could create trillions of new paper dollars to help finance those budget deficits at low interest rates without creating high rates of inflation. So this completely changed the game. When dollars ceased to be backed by gold, our economic system started working in an entirely different way that has pulled hundreds of millions of people around the world out of poverty, but it's also made the US economy and the global economy increasingly dependent on credit. Because during these decades, the third thing that has changed after dollars ceased to be backed by gold is that credit growth has exploded exponentially. Total credit in the United States, and total credit is the other side of the coin from total debt. So what I mean by this is not just the government debt, but the debt of all sectors of the economy. The government debt, the household sector debt, the corporate debt, financial sector debt, all the debt, total debt. Total debt first went through $1 trillion in 1964. By 2007, it had expanded in 43 years 50 times to $50 trillion. And that credit growth drove economic growth not only in the US, but all around the world. And now it's $85 trillion. So credit growth has become the main driver of economic growth. So it's not possible to understand how our economic system works today if you don't grasp the fact that credit growth drives economic growth in our new economic system. And when credit doesn't grow, then we run into serious problems. For instance, from 1952 to 2009, anytime total credit in the US grew by less than 2%, adjusted for inflation, the US went into recession. That happened 9 times between 52 and 2009. And every time credit grew by less than 2%, the US went into recession. And the recession didn't end until we had another big surge of credit creation. That's what happened in 2009, 10, 11. The credit creation was the government going into debt and borrowing money. And that's the thing that pulled us out of the near depression of 2008.
So it sounds to me like really the recessions now are dependent upon whether credit is growing or not. Is that kind of a somewhat accurate statement?
I like to express it like this. I believe that our economic system has evolved from capitalism into what I call creditism. It is a different kind of economic system. Capitalism was something that happened in the 19th century, let's say, or the first half of the 20th century. Economic growth under capitalism was driven by investment and savings. Businessmen would invest, some of them would make a profit. They would accumulate that profit as capital, hence capitalism, and reinvest it. Investment, savings, that's the dynamic that created economic growth under capitalism. But once the link between dollars and gold broke and credit exploded, we have a new growth dynamic now. The growth dynamic now is not investment and savings, it's credit creation and consumption, and more credit creation and more consumption. And as long as credit expands, then the economy grows. But if credit stops expanding, if it grows by less than 2%, we have a recession. If it starts to contract the way it started to in 2008, or the way it would have in 2020, if credit contracts, we will have a depression.
What I find interesting is I think a lot of people don't realize that money in our country is created by banks, and they haven't been lending since 2008. So how do you see the last, 13 years, basically, since the global financial crisis? And banks have really stopped lending in the way that they used to. I mean, I know that as a business owner, for me to get a mortgage is not impossible, but pretty close. I have a friend who has, a few $1 million in the bank and he wanted to buy a house for $300,000. He couldn't get a mortgage because it's kind of ridiculous compared to the way things used to be, but it's a lot harder now. So how is credit going to keep expanding now if the banks aren't lending?
You're right. The banks used to be the main providers of credit through most of the 20th century. But as we got into the 1970s and 80s, things changed. We saw new non-bank credit providers emerge and become even greater credit providers in the banking system itself. For example, Fannie and Freddie were relatively small in the 60s, but by the early 90s, they were providing, at least by the crisis of 2008, they were providing more money than the banking sector, providing more credit than the banking sector. And along the same lines, not quite as large as the GSEs, before 2008, we had the private sector issuers of asset-backed securities. You remember them, the ABS issuers. They all blew up in 2008 and had to be bailed out. But there are a large number of other non-bank credit providers that have emerged since the 1970s that have eclipsed the banks as creators of credit. So now bank credit as a percentage of total credit is, I don't have the exact number in front of me, but it's roughly a third of the total. Whereas in the end of the 1950s, it probably would have been 90% or more. So you have non-bank credit providers who are all tied up with the banks and also the investment banks and one another. Fannie buys Freddie's bonds, Freddie buys Fannie's bonds. And on top of all of this, you have foreign central banks buying great amounts of US debt as well, providing credit to the US, not only the US government, but to Fannie and Freddie and corporations and even investing in stocks. So the financial system has become much more complex.
I want to get back to kind of a question I was asking before with the concept of inflation. I think a lot of people have been confused by it, where it may have been more simple, as you said, in the past. It seems to be a lot more complex now. So, in the last 13 years with inflation, I think a lot of people thought it should have been a lot higher than it was stated. So how would you describe inflation versus even deflation, in the last 13 years, and where do you think it's going from here?
Can I put this in a much broader historical perspective?
Please do, yeah.
I'd like to discuss what happened in the Great Depression and why that happened, and why that didn't happen in 2008 and in 2020, and what's changed, the main things that have changed, including why there has been so little inflation in the last couple of decades. So if I may, the Great Depression, in my opinion, originated due to events in World War I. In 1914, World War I started in Europe. All the European nations didn't have enough gold to fight the war, so they all stopped backing their currencies with gold, and they issued an enormous amount of government debt, and their central banks helped finance that by creating enormous amounts of money, paper money, without gold backing. And the United States didn't enter the war until 1917. And between 1914 and 1917, the United States sold vast amounts of war materials to not only England and its allies, but the neutral countries as well. As a result, US gold reserves, the amount of gold in the United States, skyrocketed during those first years of the World War before the United States entered the war. And once the US did enter the war in 1917, they stopped demanding payment in gold and they agreed to provide credit to their allies for the war materials they were buying from the United States. But so this fundamentally destabilized the global economy at that point. It resulted in a great deal of credit creation in the war and the breakdown of the gold standard during the war, but it also resulted in the US accumulating much more gold than it had before the war. And all of the gold that the US accumulated during the war, that sparked off the Roaring '20s, because the more gold the US had, the more credit the banking system in the US could create on the back of that gold. And so the Roaring '20s were a direct result of World War II and the breakdown of the gold standard and all the credit creation that was created during the war. And all throughout the '20s, commercial credit in the US really took hold. More and more Americans were able to take mortgages for the first time. That was a relatively new thing. The automobile industry was a new thing that could be financed with automobile loans, consumer credit to pay for refrigerators. So there was a great surge of credit creation during the 1920s. And that's what made the Roaring '20s roar. But in 1930, all of that credit couldn't be repaid. And that year, we saw the first wave of bank failures. And there were two more waves of bank failures between 1930 and 1933. And by 1933, a third of all the banks in the US had gone under or had to be merged. And at that point, US policymakers really didn't know what to do. They only knew the gold standard and the rules of the gold standard. They believed in laissez-faire capitalism. They didn't know what to do. They didn't do very much of anything. And as a result, they just stood back and allowed market forces to work and allowed the market to clear. And that's what happened. Market forces worked. But unfortunately, market forces settled at the economy contracted by 45% in nominal terms if you don't adjust for deflation. And the stock market fell 90%. A third of the banks failed, destroying people's savings because the bank deposits were not insured. So credit contracted very radically. The unemployment rate went up to 25%, and international trade collapsed. And so the entire world went into a depression. That lasted for 10 years. And during those 10 years, the Nazis took over Europe, militarized Japan took over Asia, and then World War II started. And only then did the US government begin spending money on a great scale to finance the war, to build tanks and planes and machine guns and equip the soldiers and send them over to Europe initially and to Asia. And that government spending in 1941, that's the thing that ended the Great Depression. And only then. We were still in a depression up until the time we entered the war. And that was the end of the Great Depression. Massive government spending. The government debt increased by 5 times between 1941 and 1946. And that enormous expansion of government debt, which the Fed helped finance by creating paper money, the Fed's assets increased by nearly 100% during those 4 years. That's the thing that ended the Depression. But of course, 60 million people died during the war. And afterwards, by the time the war ended, the American public had come to expect the government to play a much bigger role in managing the economy than it ever had before. So the government continued to manage the economy one way or the other ever since then. So the war started more than 80 years ago. And the government, to one extent or the other, has been managing the economy subtly or not so subtly since then. Now, so what was different this time? So the Bretton Woods system broke down in 1971. As I mentioned earlier, pretty soon we started having very large trade deficits, and this led to a global economic boom, all financed on credit. But in 2008, the private sector in the US became incapable of servicing its debt anymore. And the private sector started defaulting in very large amounts of debt. And the financial sector started to collapse. The banks started to fail. And this time, however, rather than letting market forces work and replaying the 1930s, this time policymakers decided to do everything in their power to prevent the market from reestablishing a market-determined equilibrium that might once again have resulted in the economy contracting by 45%. This time, the government ran trillion-dollar budget deficits for 4 years in a row, and the Fed created $3.5 trillion over 7 years. And they, rather than allowing the bubble to implode, they reflated the bubble and made it grow even larger. And by doing that, and they were able to do that in particular because we had globalization. So they could spend all this money and create all this money without causing high rates of inflation. I think the highest rate the inflation went was in 2011. The headline inflation was 3.8%, hardly what you would expect from such massive government fiscal and monetary stimulus. So that worked. Here we are, 13 years later, and we haven't had a Great Depression. The economy's, up until the pandemic started, the economy was much larger and asset prices were very much higher. The wealth of the American public had never been anywhere near this great. I mean, it had effectively more than doubled from the pre-crisis period in 2007. So this model worked. And so when it came time, when the pandemic struck and the economy started to collapse again, the policymakers had 2 examples to follow. They could choose the laissez-faire model of 1930 or the full-out let's reflate the bubble model of 2008. And it didn't take them any time at all to decide that the second model was better. So they responded extraordinarily aggressively with government borrowing, government spending. We've had 3 massive stimulus programs. First was the CARES Act in March 2020. That was $2 trillion. Then in December last year, another $900 billion stimulus bill. And then in March this year, the American Rescue Plan Act was another $1.9 trillion. So between the time the pandemic started or the economic fallout from the pandemic hit the US, let's say the end of February last year, February 2020, from then until the middle of this year, the US government debt has increased by $5.1 trillion. And the Fed has created $4 trillion. In other words, the Fed has created enough money to finance 80% of what the government has spent. bailing us out of this pandemic economic near depression. And it's worked. The economy didn't collapse. Hopefully, who knows what will happen next with this pandemic, but hopefully we're pulling out the other side of this now with the economy still intact. Whereas if they had not done this, then the economy would have once again collapsed and could be 30, 40% smaller than it was in 2019, with unemployment back to 25%. And just imagine what the social fallout of 25% unemployment in 21st century America would look like, how nasty politics would become, which way would things swing. Global trade would have collapsed. And they've been able to get away with this because with relatively low rates of inflation, again, because of globalization. Now, it's true that this time the inflation rate year on year is currently up 5.4%, the headline CPI number, 5.4% year on year. So, of course, the CPI is an index. If you compare the July index this year with where the index was 1 year ago, it's currently 5.4% higher. But if you compare the index level with where it was 2 years ago, it's just 6% higher. So, in other words, the average inflation rate over the last 2 years is 3% a year. That's hardly the sort of hyperinflation that your Austrian economist would have taught you to expect if the government creates $5 trillion in a year and a half and the Fed finances 80% of it with money creation. And the reason we've gotten away with this is, again, globalization is extremely deflationary. Now, this spending by the government, of course, that has boosted demand and offset the collapse in demand that would have occurred as a result of the lockdowns imposed upon people and the loss of jobs. But it's not just, the inflation is not just coming from increased demand, it's also coming from unique supply-side bottlenecks related to the pandemic. Everyone's familiar with the fact that there's a semiconductor shortage. Well, why are the automobile companies experiencing a semiconductor shortage? Well, they miscalculated. When the pandemic started, they canceled all their semiconductor orders. And when they suddenly discovered that there was a lot of demand for cars, it was too late to get semiconductors. So consequently, there's a shortage of new cars now. And as a result of that, the used car prices have moved up 40%. They're 40% higher now than they were a year ago. And that 40% jump in used car prices is responsible for 1/3 of all of the inflation during the last 3 or 4 months. So are car prices going to be, used car prices, are they going to be 40% higher next year than they are at the moment? No, they're much more likely to be 40% lower. And if they move lower, they're going to knock several percentage points off the inflation numbers going forward. So we've already moved past peak demand. We had these extraordinarily large government stimulus programs, as I mentioned before, $2 trillion for the CARES Act, $900 billion in December, $1.9 trillion in March this year, that involved incredible surges in US government spending that created demand and fed directly into purchasing power by the American consumer, which led to higher retail sales. But we're not going to have any more very large fiscal stimulus boost like that on the horizon unless another disaster strikes. So that surge in demand created by these fiscal stimulus programs, that's behind us. We're past peak demand. We're going to settle back down into a period of much lower demand that's not spurred on by all of this government stimulus. And so we're past the peak credit growth because the government won't be borrowing. Government borrowing has accounted for 60% of all of the increase in credit growth over the last year. So that made credit growth very large, but that's not going to be repeated. So we're past government stimulus, we're past the peak of credit growth, therefore we're past peak demand, and demand is going to weaken from here just as we get over these domestic global bottlenecks in semiconductors and shipping, for instance. Next year, we're going to be hit by a new wave of new and abundant supply just as demand weakens, and the inflation rate is going to move down again. So the Fed, it seems very likely that the Fed is going to be proved correct. This inflation that we're experiencing at the moment is going to be transitory. And so once again, the government's policy response to this second crisis in 13 years will have been the right one. and it will have kept us from collapsing into a new Great Depression, which would have had catastrophic consequences. So 3% inflation over the last 2 years on average is a really very small price to pay when the other outcome could have been so disastrous on every level.
Yeah, I appreciate that history lesson. I think it's very helpful because I think a lot of people look at inflation, deflation, they put it into like this little compartmentalized view of what it should be. And to me, it sounds like the road ahead is going to be very rocky. So there's a lot of issues on the horizon, but where do you see the end game here? Because if they keep creating more money and more debt, there's got to be an end to that. So like from your perspective, just historically from what you've seen, what do you see their end game being? Because you can't do this forever. There's got to be a limit to this.
Well, forever is a very long time. They don't have to do it forever as far as I'm concerned. Another 30 years will work for me. But but let's talk about how long forever might be. The US government debt now is about 130% of GDP. Maybe it's between 120 and 130.
Yeah,
if you look at the gross debt to GDP. It's a moving target. It's moving pretty quickly. But Japan's government debt to GDP is twice that much. It's 260% of GDP. Japan's crisis started in 1990, and they have been managing their crisis now for 31 years. Their level of government debt to GDP was where ours is currently about 20 years ago. You could say they're 20 years ahead of us. Now, Japanese central bank has been financing this Japanese government borrowing. And right now, if you look at the total assets of the Bank of Japan, which represents how much money they've created, it's the equivalent of 135% of Japan's economy, whereas the Fed's total assets to GDP amount to 32% of US GDP. So the Japanese central bank is, relative to the size of Japan's economy, has created 4 times as much money as the US central bank has thus far. In fact, even the European Central Bank, their assets are equivalent to 62, 65% of the Euro area's GDP, twice as much as the US, as the Fed's assets to GDP. So by that measure, the US Central Bank has actually created less money than either the Bank of Japan, the European Central Bank, or for that matter, the Bank of China, People's Bank of China. So Japan's experience, what's happened there? Are they suffering hyperinflation as a result of this? No, they're struggling to prevent deflation. Do they have double-digit interest rates? No, the government can borrow money for 10 years at basically 0%, maybe 1 or 2 basis points. That tells us that the United States is far, far from being on the brink of any sort of financial sector meltdown. We have decades ahead of us, and we need to use this time wisely. Many people argue that Japan wasted all of the government borrowing and spending that their government has done for the last 30 years, building bridges to nowhere or spending the money in ineffective ways. So the US should learn from this experience. Going back to my earlier point, our economic system, creditism, must have credit growth to survive. If credit contracts, we will have a depression. So we have to make sure that credit continues to grow. How can we do that? Well, the private sector is too heavily indebted to keep credit expanding rapidly enough. When you have $85 trillion of credit in total, it's hard to make it grow by 2% a year if you adjust it for inflation, especially. What this means is we're going to have a lot of government debt in the decades ahead to keep our economy from collapsing. So therefore, we need to think about the wisest way to spend this government debt that we're going to take on. Are we going to take on a bunch of government debt and use it wastefully, fighting unnecessary foreign wars, or spending it aggressively on social welfare programs? I think there's a better alternative. I think that this debt the government is going to take on should be used to invest in new industries and new technologies on a very aggressive scale. For instance, as I mentioned, over the last year and a half, the government has increased its debt by $5 trillion. Now, to me, and without resulting in any calamitous consequences for the economy, just the opposite. In fact, the economy is now larger than it was when the pandemic started. So what should we learn from that? We've had 2 episodes now in the last 13 years where the government's gone trillions of dollars of debt and the Fed has financed it by creating trillions of dollars without creating very high rates of inflation. What should we learn from that? I believe that what this should teach us, and the way that we can grow out of this mess that we're in, not just for 30 years, but for much longer, is for the government to borrow and to invest very aggressively in new industries and technologies. I think it would be very easy for the US government to finance a multi-trillion-dollar investment program over the next 10 years, say in industries like biotech, genetic engineering, quantum computing, nanotech, green energy, all your usual suspects. And if they invested on that scale, this would induce a new technological revolution that would create technological miracles and medical marvels and turbocharge US economic growth. We wouldn't have to be satisfied with 2% GDP growth. We could have something much closer to double digits, depending on how much we invest. Now, many people worry about Social Security and Medicare going bankrupt. Ask 10 economists, they'll tell you 10 different years when these are going to eventually go bankrupt at some point in the future, 20, 30 years from now. Well, we can wait 20 or 30 years for Medicare to go bankrupt, or we can invest in genetic engineering and biotechnology and quantum computing on a scale large enough to cure all the diseases and expand life expectancy, probably not only for a few years, perhaps for decades over the next 10 to 20 years. And if you expand the working age of the American public for just 2 or 3 years, you solve all concerns about Medicare and Social Security going bankrupt at any point in the next century. So my point is, our economic system must have credit growth to expand. The private sector is too heavily indebted to finance this, but the government sector is not. We're going to end up having much more government debt one way or the other, just like Japan has done. We're going to end up with the central bank financing it, whether people like this concept or not. That's what's very likely to happen. It's that or Great Depression. I assure you, Great Depression is much worse. So we need a plan. We need a plan on how to borrow and invest. Now, I know people are cringing at the idea of the government borrowing and investing. So rather than, of course, the government borrowed and invested very successfully during the 1960s when it was in the space race with the Soviet Union, which we won. That was all done at NASA under one big roof, more or less. And it was all government financed, all government managed. It was completely successful. And the rocket technology, the intercontinental ballistic missile technology that produced, ultimately enabled us, with a lot more government investment from President Reagan, investment into the military, that enabled us to bankrupt the Soviet Union. So that all had a very happy outcome. Now, many people don't believe these days that the government can do anything successfully. So rather than using that approach where the government finances and does the investing itself, the government could do the financing, but then act as a giant venture capital company. The government could pick out the 10,000 most promising American entrepreneurs and scientists and set up joint venture companies with them. The government borrowing the money, with the Fed financing a good chunk of it, and financing these joint venture companies lavishly. And in exchange, the government keeps an equity stake of 60%. In other words, American taxpayers keep 60% of the equity. And the entrepreneurs and the scientists manage the companies and they keep 40%. And with the sort of investment we're talking about, $1 trillion is still an enormous, unimaginably large amount of money. These things would produce the most incredible breakthroughs. Cancer kills 600,000 Americans every year. The National Institute of Health, National Cancer Institute, its annual budget is $6 billion a year. That's not working. Let's increase that by 20, 30, 40 times, and you'll see what kind of breakthroughs we can get. Just look at how quickly we were able to come up with these Pfizer and Moderna vaccines with government funding guarantees and purchase guarantees. We could create miracles. This economic system that we have it creates both dangerous challenges and threats, but it also creates the opportunity. We have a different kind of economic system now. We can either choose to allow it to implode, believing that, like the Austrian economists do, that the wages of sin is death, and that we must pay for our malfeasance, and the economy has to suffer, and we all have to pay for our crimes. Or we can learn how this new economic system works. And rather than allowing it to implode, we can make it grow. We prevented it from imploding in 2008. We prevented it from imploding last year and this year. And the lesson from this is that we have the ability to borrow on an incredibly large scale and to invest in new industries and technologies. And if we do this, not only can we keep the economy growing at a very rapid rate, not only can we generate technological breakthroughs and medical breakthroughs that will radically improve human well-being, not only in the US, but all around the world, but we can also underpin US national security. Because at this rate, we're very quickly going to be overtaken by China. China is now investing more in research and development than the United States is. If they continue at their current rate of growth of investing in R&D, and we continue at our current rate of growth investing in R&D, their investment size in R&D is going to dwarf ours by the end of this decade. And if China develops artificial intelligence before the United States does, artificial general intelligence, where computers can do anything humans can do, from there, it increases exponentially. And whoever gets there first, if China develops that before the United States does, it would be the 21st century equivalent of China having a nuclear monopoly. Well before the middle of this century, China is going to dominate the world economically, technologically, and militarily, and we're going to be a second-rate, has-been, endangered power at China's mercy. So for all of these reasons, we need to learn from the lessons that I've just discussed. We are in a new economic environment, creates new opportunities that have not existed before thanks to the deflationary pressures of globalization. And this is the way forward. We don't have to just wait a few decades and wait for everything to collapse. Then we can come up with a strategy to grow our way out of this and to transition out of this and make the world a much better place, led by the United States.
As we get kind of close to wrapping up here, I wanted to ask, you mentioned China, and I know this is probably a whole talk in of itself, but obviously there's a lot going on with China right now. As of today of this taping, there's a lot of talk about what's going to happen with Taiwan, with the semiconductor shortage, and there's 80% of semiconductors are created in Taiwan to begin with. So there's that problem. There's a lot of problems when it comes to China. People have some notable concerns. So what are your thoughts on China and maybe where things are going to go with them? Because I think on one hand, they're evolving rapidly, as you said, but on the other hand, there's a lot of instability there. So what do you think happens with China from here?
So I lived in Thailand from 1990 until 1996 during the heyday of the great Asian miracle. And I was heading research departments for what is now HSBC Securities, and then also for Salomon Brothers a little later. And at first, it truly was an economic miracle. But by 94, clearly something was very, very wrong. You could look out the window and there were hundreds of cranes on the horizon building skyscrapers. And it was clear that there just simply wouldn't be enough demand. The purchasing power of the Thai public was not great enough to fill up all of these expensive condos and office buildings. And it wasn't just condos, and property, it was every industry. I had a large number of securities analysts working for me, doing analysis on every industry. And all of the industries in Thailand had quadrupled their capacity. And there clearly it was a bubble. There just wasn't enough demand down the pipeline that could absorb all of this capacity. And then, of course, surely enough, in 2007, the bubble popped. Following year, Thailand's economy contracted by 10%. The Thai stock market fell by 95% in dollar terms. And it wasn't just Thailand, it was South Korea, Indonesia, and Malaysia. So I'd been bearish on Thailand a couple of years before this happened. So much so that I almost lost my job at one point because the stock prices were still going up. And I thought I grouped China along with these other groups. I thought, China was doing the same thing these other countries were. I thought China was a bubble, and it was. I thought China's bubble was going to pop in the late 90s. I thought that all through the 2000s, 2010s. It's still a bubble, and it still could pop. But if it doesn't pop, if they continue to manage it the way that they have done, in other words, successfully, by investing aggressively in new industries and technologies, China has a plan. They have a plan on how they're going to dominate all the major industries, the high-tech industries in the world, before the middle of the century. And if their bubble doesn't pop, they're going to succeed. And if they succeed, it will be the end of democracy, free speech, liberty, all the things that Western civilization cherish. And we just can't allow that to happen. So China does have a bubble, but they have managed to keep it inflated thus far. I can't see any immediate sign that's going to cause it to implode. Their growth rate's going to slow. It's slowing as we speak, and that's acting as a drag on commodity prices and global profitability soon. But the longer term problem is the more pressing one. If they continue to invest much more aggressively in research and development than the US does, they win, we lose, game over.
Yeah, that doesn't sound very good.
No, but luckily there's no reason for us to tolerate that, because we have the capacity at the government level to borrow trillions of dollars and invest them into the dirt, just the way we did the Soviet Union when they were a threat.
We won't get into the politics, but certainly when Trump was president, there was kind of the identification of the China threat was a little bit more on the forefront. I know prior to that, a lot of the corporations were benefiting from outsourcing to China, which of course you always had the downside to that as well. Do you see that continuing where the U.S. has kind of identified the threat, and do you think that's going to change the dynamics economically? Because, we've outsourced our inflation to China primarily over the last few decades, and now the U.S. has to retool that and find other countries to outsource our inflation to.
I think that should not be a problem. After all, the global population is about 8 billion people. They say that 2 billion of them still live on less than $3 a day. So there are generations of low-cost labor. I have been criticized for saying this as if I'm cold-hearted. It's not my fault there are generations of low-cost labor. These are simply the facts of life. I don't know how many manufacturing jobs there are in the world. Let's say 100 million. Well, there are certainly 10 or if not 20 times that many people who would work for $15 a day. They're not all in China. Most of them are not in China. So there's plenty of low-cost labor in the world for us to continue to rely on to ensure that we don't have high rates of inflation in the United States. Meanwhile, if we invest and create new technological revolution, an investment revolution, creating products that will benefit everyone in the world and drive global economic growth all around the world, everyone will benefit from that. So in terms of the politics, or let me say, there is some sign that the Congress and the Senate and the House, they seem to be catching on. As long ago as, well, more than a year ago now, Senate Minority Leader Schumer said that if he got into office, he was going to propose that the United States, he was going to see through a bill that would have the United States government invest $100 billion over 5 years in new industries and technologies. And he named in particular artificial intelligence. This was at a speech in front of the US military defense establishment in Washington. And he laid out the case that if China gets to AI before we do, it's game over. So he proposed $100 billion over 5 years. Well, they've actually moved ahead with that. And a bill like that has passed the Senate now. And I bet it will pass the House as well. But $100 billion is just not going to do the trick. I tweeted, Senator Schumer, I'll see your $100 billion and raise you $9.9 trillion, because $100 billion, that would be $20 billion a year. Well, China is way ahead of us already in terms of spending. 20 extra billion a year in investment in R&D is not going to help us. We need to think on a much grander scale. And hopefully, this experience we've just lived through, where the government debt has gone up by $5 trillion in a year and a half, will illustrate what is possible.
No, that's great. No, I appreciate the insight. Well, Richard, we got to wrap it up here in the interest of time. As much as I could probably talk to you for another few hours. This has been a real
Kirk,
treat.
I'm happy to close here, but we haven't discussed at all the investment implications of or the investment outlook for stocks or interest rates or property or gold over the next few months, which is what I normally focus on.
Let's talk about that for kind of a final segment here as we kind of wrap it up. So why don't we talk about the investment implications, and then we can, or we could just have you back, which I would love. So let's talk about the investment implications.
Okay, so where are we now in terms of looking to the future? I've always already mentioned in great detail that credit growth drives economic growth. The other thing that must be understood is that these days, liquidity is the thing that determines which way asset prices move. And where does the liquidity come from? Primarily, it comes from the Fed right now. The Fed has been creating $120 billion a month since March last year, and it has basically doubled the size of its total assets since that time. And this has made it possible for the government to borrow trillions of dollars at low interest rates. So today, the 10-year government bond yield is just above 1.2%, maybe 1.22%. It had been as high as 1.75% back in March, and people expected it to go higher because they expected inflation to keep moving higher. But once people began to realize that we'd gone past peak demand and that the economy would begin to slow, they realized inflation would begin to slow. So inflation rates have come back down. Now, the most important topic in the financial news is when is the Fed going to taper? And how quickly are they going to slow down this provision of liquidity? I think they're going to slow it down soon, not so much because they're afraid of the high rates of inflation, because they really do believe that's transitory. But what they're really considering is how much is the government going to borrow going forward? Because the Fed is creating $120 billion a month. If they did that for the next year, 120 times 12 is 1.44 trillion. Well, that's likely to be considerably more than the US government is going to borrow next year. Last year and this year, the budget deficit was $3.1 trillion last year, just over $3 trillion probably this year. But next year, the Congressional Budget Office is forecasting only $1.1 trillion budget deficit. So if the Fed were to carry on with $120 billion a month, they would buy every new government bond sold and then another $300 or $400 billion on top of that. And of course, that would have pushed the bond prices very, very high and pushed the 10-year bond yield perhaps back well below 1% again, which would fuel the stock market into a very big bubble and the property market into a bigger bubble. And they don't want to do that. So suddenly they have, things have become more clear about how much the government's going to borrow. And this is going to require the Fed to start tapering. So we have Fed Chairman Powell making a speech toward the end of this month at Jackson Hole, where he's going to drop some big hints that they're going to start tapering before very long. Now, they may be getting a little cold feet because of the pickup in COVID cases related to the Delta variant, slowing the economy and slowing retail sales. But despite that, it looks now that people used to think they would taper starting in January, but now it looks like they will taper perhaps as early as November or December. Before, people expected the tapering to go on all year long next year, but now it looks like they may end it by the middle of the year, resulting in far less money creation by the Fed. And so if that's the case, we're still going to have a lot of liquidity. Say if we get $120 billion a month for the next 3 months, well, that's another $360 billion of liquidity just for the next 3 months. So the liquidity is going to be there for the short term, but it's going to start drying up pretty quickly next year. And that means we're likely to see this liquidity has been the thing that's pushed stock prices higher to record highs again and again and again all this year. Well, we're going to move into a period now of increased volatility, as we've just been seeing this week. Bull markets don't last forever. The liquidity very possibly will keep pushing stock prices higher for the rest of this year. After all, when the Fed tapered last time during the course of 2014, the stock market kept moving higher. The stock market didn't even wobble until a year later when the Fed increased the federal funds rate for the first time in December 2015. And then after that, it kept moving higher. So that may be the case again. The stock market may continue to be well supported as long as the Fed is continuing to create liquidity. But we do have to consider that asset prices are very inflated now. So it does look like we're in for a period of much more volatility in the stock market than we've seen thus far. So if interest rates, first they'll be tapering, and then depending on how strong the economy is, it's possible that the Fed will begin increasing federal funds rate. But of course, if the Fed stops quantitative tightening, then it will stop buying government bonds. And without the Fed buying government bonds, the government will still be borrowing. And that will tend to push up the 10-year government bond yield just through market forces. And so we should begin to see interest rates move higher through the course of next year. That will not support the stock market. It won't support the high-flying tech stocks, and it won't support the property market. So the big boom that we've seen in asset prices since the Fed announced that it would do effectively whatever it takes last March, we're unlikely to see that again next year. And as for gold, last time inflation peaked, gold prices peaked. And between 2011, when gold prices peaked, over the next 4 years, gold prices fell 40%. So if inflation does prove to be transitory and start coming down, as appears quite likely, and at the same time we see less quantitative easing and higher market-determined interest rates, that would likely put upward pressure on the US dollar. All of those things would be very bad news for gold. So those people who have invested on a strategy based on the premise that we're going to see much higher rates of inflation need to reconsider their assumptions.
Let's wrap it up here in the interest of time, and we can have you back on in the future as the economy evolves. There's so much to talk about, but I really appreciate you coming on the show. Can you tell the audience who know you or aren't familiar with you, where can they find more about you? And I know you have some books as well where people can learn more about a lot of the topics we talked about today.
My business today is called MacroWatch. MacroWatch was started 8 years ago. It's a video newsletter. And every couple of weeks, I upload a new video. It's basically me making a PowerPoint presentation discussing the sorts of themes we've been discussing related to investing, not so much on government policy, but on the outlook for asset prices and what the government's doing and how that's likely to affect credit growth, liquidity, and asset prices. If your listeners would like to learn more about MacroWatch, they can visit my website at richardduncaneconomics.com. That's richardduncaneconomics.com. And if they would like to subscribe to MacroWatch, I'd like to offer them a 50% discount. If they hit the subscribe button and type in the discount coupon code TREE, that's TREE, they can subscribe to MacroWatch at a 50% discount. They'll then get one new video every couple of weeks and have immediate access to the 75 hours of MacroWatch videos in the archives. So I hope your listeners will check that out.
Well, that's the show for this week. So thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out our show on moneytreepodcast.com. On our website, you'll have access to our resources, show notes, and archive shows. Lastly, please be a friend and rate the show and provide a comment on the podcast app of your choice. When you subscribe and rate the show, it allows us to get better access to some of the top guests that you're going to want to hear. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.
Thank you for listening to the Money Tree Investing Podcast. Visit us at moneytreepodcast.com for more free investing resources.